Hello, everyone. Thank you for joining first of a series of these that we're going to do. But topic, of course, is advanced tax planning. I guess I call it tax planning strategies. But we're going to cover a variety of things on this call. But before we do that, let's get into some of the formalities here. First of all, hi, William. First of all, a couple things. The slides here, there is a handout section. Very important to download that if you enjoy the webinar, because there's a lot of links to a variety of these strategies and structures. So that'll be very helpful for you. That's on the top right. There's also, we won't be doing a polling question there, but there is a chat feature there. So some people have shot out here, hello, and comments. Feel free to, as I go through this, note your questions there. I'm going to cover questions at the very end. I'm not going to do it. I'm not going to do it as we go. We've got a lot of material to cover. So note your questions, and at the very end, I'll go back and I'll go through them. Okay. A couple other things just to discuss. First of all, timing. The webinar is technically an hour, so I'm going to cover a lot of material here in the next hour. Then I'm going to be around for up to an hour of Q&A. I don't think it's going to take that long to go through it but I know there's going to be a lot of new structures and strategies for a lot of people, so you might find that people have a lot of questions. Is this being recorded? Yes, it is. We'll put it out on the YouTube channel, and for everybody who is on here, you should get a replay email tomorrow. So if you got to cut out after a half hour, or you can't stick around for the Q&A, absolutely fine. Hopefully you're able to get at least something from the webinar. So, all right. A couple other formalities. Most of you obviously have talked to me, know me. I used to work, a little bit of background though, I used to work at PricewaterhouseCoopers, PwC many years back. I also worked with thousands of companies all over the country. And you can find some of my articles out there in Inc. and Kiplinger. So if you can't sleep at night, those are good things to read. They'll put you right to sleep. So feel free to take a look at some of that. But other than that, I think most of you are aware, I'm a CPA and used to do a lot of strategies and structures with a lot of my clients. But the defined benefit plan and cash balance plan was one of the ones that I ended up spending a lot of time on. You know, this is going to hopefully give a little bit more education to some of you, the folks out there who are looking to understand and reduce their tax liability. First of all, a quick disclaimer. I want to say that, you know, this is only intended for educational purposes and informational. Everybody's situation is unique. I certainly believe that the vast majority of the people on the call will find a few things that are very interesting to you, even though we're going to cover 50 plus topics. You know, you're going to get a little bit of something out of it, but everybody's situation is unique. So I definitely encourage people to take a look at the resources afterwards, and then, you know, certainly reach out to your CPA if you want to make sure that you discuss these structures with them, to make sure that you can try and put some of these to work here before the year runs out. So, okay. A couple other ones on an overview. Just so you're aware, there are a lot of people, you've probably seen a lot of things where people talk about, you know, tax strategies, and usually they're very basic things like, you know, you want to set up a 401k plan, or you want to do an S corp to save unemployment taxes. These are going to be generally very advanced structures. Again, not applicable to everybody, but going to be applicable to a lot of folks. So I'm going to cover them in broad, you know, kind of broad categories. And these are great to be able to take to your CPA. As a CPA myself, I know that we as a profession don't do a very good job of tax planning. We do a very good job of tax preparation. But when it comes to getting clients out in front of these, it can be challenging. So I know there's a few CPAs on the call as well. And some are implementing these, but again, a little bit more that information that they can understand. Second comment was kind of on the disclaimer side. the IRS has a doctrine called the economic substance doctrine, and they want to make sure that any strategy you use is not necessarily just for tax planning purposes, but there's an economic purpose for it. So again, I encourage people, don't just jump into a lot of these strategies or set up a lot of things. You want to review these and analyze these things very carefully. Also, I know it sounds kind of rude there on the bottom, but I'm doing this, I guess I'd say, out of the kindness of my heart. I've had a lot of clients who have asked me these questions over the years. I felt it's probably good that I do some webinars on these. Certainly, if people enjoy this, we might choose to do a little bit more of it down the road and do some deep dive into some of the categories. But I can't, there's not enough time in the day to answer the questions on all these. Plus, I don't have anything to sell you. Most of these strategies, other than the DB, plan side of things, we're not, I'm not setting them up. I do some very rare tax consulting, but for the most part, this is between you and your CPA to review and make sure you're up to speed. Okay. Some of the planning topics here. Again, we're going to go through this pretty quickly. Entity structures, kind of a basic strategy, but want to talk a little bit more about it. Retirement, health and family, health and medical. We'll talk a little bit about an HSA, but also Section 105 plans. Talk about when it makes sense for family, children, some of those. Fringe benefit plans, that comes up a lot and people really don't know what those are. There's also some special deductions. We'll talk today about conservation easements and DAFs, donor advised funds. Also some special structures. We'll talk a little bit about 1202 stock, and captive insurance, tax credits, just a nice reminder of tax credits that are available, and talk a little bit about a few new ones. Real estate comes up a lot when I talk to clients. So a couple strategies that I know people are doing. We'll talk briefly about investments and insurance. I say probably my most important one for last, it's estate planning. The reason why it's the most important, or maybe my most favorite, is because very few people understand anything about estate planning. I'm going to talk for maybe 5 minutes on it. So very important, because there's some huge changes over the next couple of years on the estate planning. And of course, my clients tend to be very high income, high net worth people. So there's some things you're going to want to consider as we get close to 2026. Okay. So that being the case, let's jump in. Entity structures. Again, I think of this as more of a basic strategy, but I want to make sure people understand how these structures work. We're also going to talk about the best structure, which is going to be on the next slide. First of all, sole proprietor. Many people know the income is subject to self-employment tax. It's on your Schedule C. You file it with your personal tax return. Very simple, very easy to do. Generally not the most tax efficient. Also, Schedule Cs are subject to the highest amount of audits from the IRS. So something you want to be very careful. But I was going to note here that I know a lot of CPAs push S corps for most standard operating practices out there, and I get it. That is the kind of the great business for a mom and pop business or someone who's just working. But I do find a lot of CPAs that will have let's say a physician that makes $400,000 a year working at a hospital and makes $200,000 in 1099. Often they'll put those physicians in S corps for their side income, and in my opinion, there can be some problems with that, just because of the W-2. You've got to pay employer employment taxes if your income's above $160,000. So if you've got a large amount of W-2 income and a big amount of W-2 income, and you're over 160, where you're over the Social Security cap, and you've got a Schedule C or some side income, you may want to keep that as a sole proprietor, because it is also going to allow you to do some other fringe benefits. So if your CPA is pushing you in that direction, you may want to take a closer look at it. Okay. S corps, most people know they're self-employment tax blockers. You got to pay yourself a W-2 for a reasonable wage. Gives you a little bit of audit protection. Rather simple, easy, straightforward. They're pass through. Not going to talk a lot about them. C corps. If you make 7 figures a year, my opinion, you absolutely should have a C corp. In fact, if you make less than that, a C corp can make a lot of sense. But I do understand that structures can be complex. CPAs are going to charge you for tax returns. There's a lot of moving parts. So it'll make your head spin sometimes to go through all these structures. But C Corp's top S Corp rate, 37% flow through. C Corp is 21%. So they can work very well in a variety of situations. We're going to talk a little bit more about some of those. Trusts, people talk a lot about trusts, revocable, irrevocable. Revocable trust, living trust, not a lot of no tax changes or considerations there. Irrevocable trusts can help you sometimes from a tax standpoint, from an income tax, but they're very big on the estate tax, also on the asset protection side. So again, trusts aren't really good, generally speaking, for most operating businesses, okay? So we'll talk a little bit more about trusts later in the estate section. Now, the best structure, we're going to go to the next page. This is the structure I would recommend for high income folks setting up a new business. Again, you've got a bunch of tax returns to file, and it might make your head spin. So you maybe don't necessarily want to do this. And I'm not telling you to run out and go to your CPA and say, hey, change my structure. This is what I want. Because again, it's not necessarily easy. So just kind of do some quick review. But one of the structures I always would do with high income folks is all your income from your business comes through to a partnership return. A couple different ways you could structure a partnership. If it's just a solo person, you can have a trust. Certainly you can have a spouse or other types of ownership. That acts as sort of like a funnel, and the bulk of your income goes to the S Corp. S Corp's going to have flow through taxation, going to minimize employment tax, also avoid double taxation. But if you can do a guaranteed payment or a portion of your income can go to a C Corp, you can take advantage of excess income that you don't need to spend right now at 21%. So you can take advantage of a lower tax rate. It frees you up for fringe benefits. It also frees you up for estate planning and some of the other estate planning strategies we're going to talk about. But for example, you can take the money into a C Corp and you can have your kids be owner of the C Corp, for example. And, you can pay yourself a wage for the work that you do, but any dividends that are left over can be dividended out to children at very low tax rates, qualified dividend rates. So there's a lot of really cool things you can do from an estate planning standpoint. And again, it allows you to get some of the fringe benefits. We'll talk a little bit more in detail. Again, complex structure, but works very well for a lot of folks. A note I've got on the bottom here is to use a common paymaster. You probably don't know what I'm talking about, but when you have a partnership does not have a W-2, but an S Corp and C Corp does. We just talked a second ago about S Corps paying the employer payroll taxes. If you use a common paymaster, which basically ties your S Corp and your C Corp together, the payroll tax will stop at $160,000. So it prevents you from going over the Social Security cap between the two entities. So again, someone might come to me and say, well, if I pay myself 200 grand on my S Corp and 100 on my C Corp, now I got to pay employer taxes on my C Corp, not if you use common paymaster. So talk to your payroll companies if this is some approach you want to take. Retirement. Most of you are well aware of cash balance plans and defined benefit plans. We're not going to talk about that, other than to note that I do have some folks, very high income, who can do 3.4 million. Many people are aware of this. 3.4 million into a plan. I do have some other high income folks that have been able to structure plans to get around control group rules to also have economic substance where they're able to contribute to two separate plans. So it can make sense in the right situation. Again, I throw that out there. It's something we may address in a little bit more detail. Mega Backdoor Roth, I think a lot of people are aware of that. Essentially what this does, though, for people who are not aware, it allows you to get up to your 401k limit with after-tax contributions. Allows you to get an extra $20,000 to $30,000, give or take, into retirement as an after-tax. And then again, that after-tax is at some point you could roll it over into a Roth. There's actually a Roth 401k component to it. So very good structure. Again, something I think we've had a lot of information out, and you might see some more from us. Backdoor Roth, just want to make sure people know this is available. There's some tricky issues to go through as it relates to the pro rata rules, but sometimes people come to us and ask us about illustrations for backdoor Roths. Realize that's between you, your financial advisor, and your custodian, not a structure that we get involved in, okay? But it's definitely available. I encourage everybody to look at it to the extent it works for you. It's simple Roth money. Roth 6% penalty loophole. I think I might have mentioned before, maybe I didn't, but there's going to be a lot of structures I think that are going to be completely new to some folks that people aren't aware of. This is a structure that's been around, kind of a loophole that's been around for a long time and hasn't been as big of an issue until recently, now that we're getting this very high interest rate environment. What this allows you to do is people know that, I think for the most part, that if you make over $225,000, you cannot put money into a Roth. But if you do, the IRS tells you to pull that money out. If you don't pull it out, there's an excise tax of 6%. I've had a couple people in the past that did this, and they were a little more risky, where they would put excess money into their Roth. So they funnel, $100,000, $200,000, $300,000 into a Roth. They pay the the 6% penalty, but the Roth is in a very aggressive plan. Let's say you time this perfectly, and this was in Bitcoin, and anything over the 6% is obviously your income. And then at some point you pull out that contribution, and you're outside of the, and whatever's left in the Roth stays in the Roth. Very cool strategy, very risky, not for a lot of folks, but very interesting. I know I've got a few tax geeks on this call, so if you're curious, play around with that. 2024, a couple of very important changes that, again, a lot of people aren't aware of. First of all, as the rules now stand for the Secure Act 2.0, there's a lot of debate about the catch-up contributions, right? Most people are aware that you can put in, for example, this year, $22,500 into a deferral, and then you can get in up to $30,000, the extra $7,500 if you are over, if you're 50 or over, okay? People are aware of that. Next year, if your W-2 is over $145,000, that catch-up contribution piece is not allowed to be deductible. It is actually going to be put into a Roth account. So you're going to need to check with your plan custodians to see how that's going to be structured, because you're going to want to track that money and you're going to want to open up a separate account. So if you want to do this early part of next year, that's something you're going to want to talk to your custodian about, the investment advisor side, okay? Also, the way the regulations are right now, in theory, the IRS has outlawed catch-up contributions for next year, but the IRS has come out and said there's going to be some technical corrections. They didn't intend to do that, so it looks like you're still going to be able to do the extra amount, but as it stands, it's going to be Roth. So initially, not great news. But realistically, it's only $7,000, so it's not that big of a deal. Another thing I wanted to point out here is that the higher interest rate environment equals a lower funding range. What you're going to start to see on DB plans is where you get those high maximums. Those are going to start to come down a little bit because they have to use the federal, the applicable rates for the IRS. And as those are coming up, as interest rates get higher, then contributions in theory come down. So you'll see ranges start to be a little compressed. That's going to be the case a little bit for 23 and probably 24. Who knows what's going to happen after that? But again, something that you want to pay attention to. We'll probably talk a little bit more about this as we go through some of the fall, webinars. But again, definitely do some research on some of these. And I've got a couple articles, I think, in the back on them as well. Health and medical. I'm trying to not do, like I said, a lot of very basic strategies or structures. But an HSA is obviously very important. If you're not doing an HSA, you absolutely want to set up an HSA. Again, most people are able to do that. And an HSA gives what people call triple tax deductions. It's a tax deduction when you put the money in. It grows tax-free or tax-deferred. And then when you take the money out for medical, as long as it's used for medical, it is tax-free at that point. So, excuse me here, I'm going to turn my cell phone off. That was kind of smart there. So definitely make sure you're taking advantage of that. Again, very basic strategy. Section 105 plans for sole proprietors who have spouses. Section 105 plans are medical reimbursement plans. The company actually reimburses you. They're a deduction on the C Corp tax return, not available for S Corps. They also work very well if you're a sole proprietor who has a spouse. Again, another reason why, if you've got a high income W-2, why setting up an S Corp might not be the best strategy for you. You might be better off just being the sole proprietor, because then you can take advantage of Section 105 plans. There are some restrictions when you've got both that and an HSA, but again, something for you to consider and take a close look at. They're very simple and easy. We've used core documents in the past. You can set them up for $200-300. Great strategies and structures. I encourage everybody to look at them. 401h plans. A lot of people aren't aware of these. There is an IRS code 401h, H standing for health, allows you to contribute money into a health reimbursement account, so to speak, that you can use when you retire. We've dabbled in these from time to time. There was a big provider who used to do these, not doing them anymore. But right now we're not doing these. We hope to roll them out at some point in the future. The main reason we're not doing them is because of the fact that the IRS says they're legal, says they're okay, but they haven't really given a lot of guidance as to how they're supposed to work and how they're supposed to be structured. As a result of that, a lot of plan providers, TPAs like myself, consultants, stay away from them because of the ambiguity and the risk associated. Again, not something we're doing, but something we may be doing in the future. I just raised the issue in case people want to take a look at it themselves. So next section, family and children. These come up a lot. First of all, hiring a spouse. Sometimes people say to me, should I hire my spouse? I hear it's a great tax deduction. Well, if you hire your spouse, if your spouse works for you, which if they do work for you, they should be on payroll. The IRS would like to get your payroll taxes. So, but if you pay your spouse 20 grand a year, that's a deduction for your S Corp, but it's income to your sole proprietor, okay? Or excuse me, income to you on an individual level. So it's a wash. You're really going to be out for out of pocket for the employment taxes. So generally, it's only wise to do, unless they work substantially for your business. Only good to do if you want to use them in retirement, if you want to add them to your cash balance plan, or if you want fringe benefits. Some of the fringe benefits we're going to talk about, or a Section 105 plan, something along those lines. Okay, so definitely something to consider. Hiring children. This comes up a lot. You can essentially hire your children, pay your kids up to about $13,000 a year. You can, generally speaking, still claim it as a dependent on your tax return. They do not have to file a federal tax return. However, a lot of people say they don't have to file a tax return. Not completely true. You don't have to file a federal because the exemption is $13,000 and some change, but they may have to file a state tax return. Obviously, they're not going to owe a lot of tax at all, but definitely check to see. I think it's half the states might require a tax return to be filed. So take a look at that and see. Paying them up to the $13,000, you don't have to include them in your retirement plan. Great option. There's also a little trick per se that the IRS allows you if you're a single member LLC or a sole proprietor, a complete sole proprietor. Again, another reason that we talked about, you can pay your children and it's not subject to Social Security and Medicare. So again, pay your children $13,000, no Social Security and Medicare. Child doesn't have to file a tax return at the federal level. You get the tax deduction. Very much a win-win. Can be a little bit of a headache because of the payroll reporting, but again, something for you to take a look at. I think I've got an article in the back. Another great structure we would recommend is Roth for children. They can put in, $7 grand a year. You pay them 13. Great opportunity to put in $7 grand a year. It's a Roth. By the time your kids retire, it'll be worth, 30, 40, 50 grand, something like that. So very good. Also, income splitting, and really income splitting is a very generic term, but income splitting kind of encompasses trying to allocate income to different folks. This can be great, like I said, if you've got a C Corp where you've got your kids on as a C Corp and they can take dividends out of a company. if you've got it set up a variety of different ways. Again, you can structure it. So again, that can make a lot of sense and going to be very relevant for estate planning. Fringe benefits, again, talked a lot about Section 105 plans. Not going to go into that much detail. Fringe benefits covers a wide variety of things. There are fringe benefits that are non-deductible. There's all kinds of different types of plans, but realistically, there's not a ton that make a lot of sense. The few that I've seen, and that's why I wanted to highlight, Section 105, tuition reimbursement plans can work very well. Tuition reimbursement plans, though, again, work very well for C Corps, sole proprietors, but that example with your child earning a certain amount of money, your company can offer a tuition reimbursement where you can reimburse your child for up to $5,250, just over $5,000 in tuition every year as a reimbursement. You can offer this to all employees. You want to be careful if you've got to practice with a bunch of employees because there could be control group issues. But a lot of people aren't able to get the credit for their kids because their income is too high for income phase outs of tuition. And so this is a great structure for people who have kids in college. Take a look at it, consider it. Again, I think I've got a link in the back. People bring up a lot, deferred compensation plans. I want to set up a deferred comp. I want to know what's going on. Well, deferred comp generally does not work for small businesses, S Corps, because a deferred compensation plan is a non-qualified plan. It allows a company to take compensation that might be earned to an individual and defer it into the future, at which point they'll take it out. Very large company. When I was practicing when I had my tax practice, a lot of people at Intel had these plans. A lot of large companies had them. But for small businesses, it just doesn't make a lot of sense because a true deferred compensation plan, the corporation is still going to have to pay tax. So the corporation can't take the deduction until the employee takes the income. But there are some structures that can be used with insurance and a lot of other things. We might do some breakout strategies with these things in the future. But again, deferred comp, probably not something that's going to be applicable to a lot of folks here. So probably something you could take a look at and then get out of your vocabulary, unless you've got a few people, a very large C corporation, 50 or 100 employees. There could be some structures there for you to do. But for the average, attorney, consultant, IT person, probably not something they're going to be able to do. Okay. Special deductions. Conservation easements. People bring these up a lot to me. I'm not a big fan, but what they are basically is they're purely a tax play. IRS doesn't like them that much, but basically what you do, you put $50,000 into a fund and or partnership. Partnership bundles all this money with wealthy people, and then the partnership then goes out and gets a conservation easement and gets a valuation, a very large valuation on that conservation, whether it's mountains or deserts or swamplands or whatever. And then they distribute out, they donate that plan, they distribute out a tax deduction. And if you put 50 grand in, you might get a tax deduction of 100 grand. Well, you get 100, or excuse me, let's say 200,000. We get a deduction of 200 grand. You live in California, you're in a 50% tax bracket. You're going to save $100,000. So basically your $50,000 investment, so to speak, turned into $100,000 in cash. Can work. Not a big fan of them. There are some people out there that do them. They're really tough for CPAs, but again, people do bring them up from me. There's not a lot that straight W-2 people can use for tax purposes. So this is one I would see people who didn't have businesses try to do. But again, something to consider. Next one, donor advised funds. There's a variety of structures around donations. As people are aware, you can make a donation and take a tax deduction for it. Donor advised funds are kind of nice because you could contribute money into these accounts, and actually they can be set up at Fidelity, Schwab, Vanguard. I think most of them have donor advised fund accounts. And with those donor advised fund accounts, they allow you to make a large contribution. You take the deduction when you make the contribution, and then you can pick and choose the charitable entities at a later date. And the only reason I bring this up is occasionally I'll get a client that says, hey, Paul, I made $400,000 last year. This year I'm going to make $1 million. What can I do? Well, sometimes I'll say it's good to bunch your donations or even set up a donor advised fund. Maybe you like to put, maybe you normally do $10,000 to your church or to some organization. Well, this might be a good opportunity for you to put 50 grand in, take the tax deduction when you've got a very big bracket, and then distribute the money out of the donor advised funds to the charities over the next 3-5 years or immediately. That way you can bunch them, get the deduction when you're in a higher bracket. They can work very well. There's also some other things that we've done before on personal foundations and some other things like that. But I didn't want to get too detailed into charitable contributions. There could be a lot of things that can be done. But again, that's one thing to look at if you're in a very high tax bracket and you want to be charitable. Next one, the Augusta rule. I actually think of this as a very basic strategy, even though most clients aren't doing it. The Augusta rule is also called the 14-day free rent rule. Again, a lot of people use it as a basic strategy. What this says is you can rent your home out essentially for fair market rent for up to 14 days a year, and you don't have to pay tax on it, and it's not taxable income to you. So I should say you can also have your business rent your house for 14 days. There's certain rules and restrictions, but you can have your business rent your house. That can be a deduction for your business and not income to you personally. Not a huge amount, but I've seen people do these for, $5 grand or whatnot. It's got to be free rent. There's some other things, but again, something to consider. Want to throw that out there. Oil and gas is another one of the deductions that allows you to get large deductions, depreciation deductions up front. Variety of different partnerships that are structured that will allow you to get immediate deductions on that. You have to also weigh that with the income you're going to receive from the oil and gas structure and so forth, but definitely something that you can consider. It also ties a little bit into some of the solar tax credits and investment tax credits, but again, I just want to throw that in there. Some people are aware of that already. Special structures. Captive insurance. First of all, people bring up captive insurance a lot for me. $2.6 million exclusion. Let me show you how this works. You get, if you set up a captive insurance for your business, basically you're self-insuring your business. And you can take a deduction as high as $2.6 million. And you can take that deduction in your operating entity, and that goes over into an insurance entity that you claim. And as long as the contribution is equal to or less than 2.6 million, it is not taxable income to you on that and that C Corp. So a lot of people probably are saying, wow, that's awesome. I make $1 million a year. I'm going to take 500,000 out of my company and I'm going to send it over to this, I'm going to send it over to this C Corp. I'm not going to pay income tax on the C Corp. I'll pay tax on any sort of interest or dividends that 500,000 gets me, but I'm going to get an immediate tax deduction. And yeah, in theory, that's correct. But in practice, first of all, you're never going to be able to justify a $500,000 deduction. I mean, you could possibly if your income was very high. Typical deductions are going to be, I would probably tell you 10 to 15% of your revenues. So, you might only be looking at a deduction of a couple $100,000, but there are fees involved. A lot of these are going to require some setup fees. Most of your captive are going to have certain retained risk on maybe 10% of your contributions into the plan, and also maybe $5,000 a year to administer and or to set up. Can work very well for large companies who have employees that can't do a lot into DB plans. Also can be a great, we talked about estate planning, can be a great estate planning tool because you can have your children, own a portion of the captive, because at some point you're going to need to get the money out of the C Corp. So a lot of very, very cool things that can be done. Again, might excite a lot of people, but pay attention to the fact that there are fees and costs, and you might not get as much bang for the buck out of the gate that you might have thought. 1202 C Corporation stock, also called QSBS. It basically allows you to get a very large exclusion for capital gains when you sell a C Corporation. Not applicable to a lot of folks because a lot of my clients are attorneys, financial advisors, CPAs, physicians, IT professionals. A lot of those professional services aren't going to qualify, but I've been involved in certain structures where we were able to take a professional services piece and keep it in an S corp and strip out, patents, copyrights, other types of intangibles to put into a 1202 C corp. Then when the company is sold, you pay tax on you allocate the sale price between the two different entities. You pay capital gains on the S corp. You pay no capital gains on the 1202 stock. So some very cool things that you can do. Again, just wanted to touch on it very quickly. Restricted property trust, another one that we're not going to talk a lot about, but this gives you the ability to put monies into a restricted trust. IRS had some issues with it. The IRS lost a pretty big court case on it a year or so back. So very interesting structure. Google it. I've got some good resources. Take a look, see if it works for you. Lastly, 529 plans. They've been updated and revised a little bit with the Secure Act 2.0, but they give you the ability to not only make tax deductions that are going to be tax contributions that are going to be deductible generally at the state level, but then you can roll out $35,000 into a Roth at a later date if need be to beneficiaries. So again, take a look at it. I've got some articles on it. Very, very cool strategy that can work out well for some people. But again, something to consider. Most people who did 529s, I've just found that they just never made, they just never were able to get enough into them to justify some of the costs of college. But again, it's been changed here and might be a good opportunity for you to take a look. Tax credits. Highlighted a handful of them here. First of all, R&D tax credits. I get asked this question a lot, and there are people out there who think that R&D, this was originally set up for, again, large R&D companies, people building an app, people building a variety of things. The cool part about R&D tax credits is that R&D tax credits will, they're not just for IT folks. They're really for anybody who has any sort of technological function that they're trying to build within their business. I've seen it work for dentists. I've seen it work for physicians who have larger practices where they're trying to integrate some sort of system or some sort of architecture. They give you a lot of credits. I should certainly preface this by credits are much better than deductions. A credit is dollar for dollar. Most people are aware of that. Deductions are only going to come off at your marginal tax rate. So you take $1,000 credit, it means $1,000 reduction in tax. You take $1,000 deduction, it only means a $400 savings, assuming a 40% tax bracket, okay? R&D tax credits, again, for my people that are software folks, IT folks that build businesses, take a look. It can make a lot of sense for people who are even physicians. It can work out well. I've worked with a company called KPHE. I've got them in the back. There's a couple other providers back in there. Again, I'm not recommending anybody. I'm not trying to sell you anything. So take a look at it and, something for you to explore. Solar and investment tax credits. Many people are aware that there was the Inflation Reduction Act that just came out. Well, there's solar and investment tax credits where you can write off in the first year between state and Fed credits up to 80% of your investment. And then you get the residual over the next couple years, but then you can also get an earnings tail where a lot of these projects are expected to pay out 5 to 10% over the next 20 years. So hypothetically, you could put $100,000 in, take a credit of say 40 grand, and then take another chunk of deduction based on the depreciation. So maybe get in upwards close to 80%. And then you can earn a 5% residual on the solar project. I've actually got in my resources sort of a case study of how it was done. Again, not recommending it for everybody. One of my biggest concerns is it sounds great from an economic standpoint because I get this huge benefit and then I have this tail of earnings. But look, there's no guarantees. I don't know if people have seen a lot of solar stocks lately, but solar stocks are in the toilet. And so, the tax planning side may be great, but the investment side of it might not be so great. So take a look at it, see if it works for you. State tax credits. A lot of states have a lot of additional incentives that people just aren't aware of. Dollar for dollar credits on donations. There's a lot of state and local for even things like a lot of new ones in there for cars. I know Colorado, for example, you buy an EV, they give you a $5,000 state tax credits. A lot of really cool credits at the state level. I encourage you to take a look at it. And I also find that there's a lot of CPAs that work with clients in different states. And I think that's fine because I think the relationship is important. But, if I'm a CPA in Arizona and you're in Maine, I can't be expected to necessarily know every single state tax credit in Maine. It's very overwhelming. And so that is one of the downsides, is that a lot of CPAs aren't aware of these. Definitely do your diligence and take a look at it, okay? Educational credits. Many of you may know that you can get a credit of, $2,500 for credit for children when they go to school. However, those are phased out in around a couple $100,000, okay? And so vast majority of my clients, are earning, $400,000 to $700,000. So it's not going to be something that they can do. However, should you be able to put your kids on payroll? Maybe you've got a child in college that you can pay this child $25,000 a year to work for you on the side. Your business takes the tax deduction for the $25,000. You can't claim them as a dependent, so you lose that. The child then takes the income of the $25,000, puts $7,000, $7,500 into a Roth, and then the child then, since they're claiming themselves, they're able to take the educational credit. And essentially, if you pay your kid $25,000 to $30,000 a year, you get a tax deduction for it through your business, and your child gets to write off the tuition. So some very cool things. Again, this ties into a lot of the income splitting. Think about that. Talk about it with your CPA if there's some structuring you want to do. We're just taking the child payment of the 13 grand and we're just kind of taking it to the next level. So again, something for you to look at. Retirement plan credits. Very relevant. A lot of people are unaware that the Secure Act and the Secure Act 2.0 came out with retirement plan credits for setting up new plans, also for contributions to plans. You can get up to $250 per non-HCE, and you can also get up to $1,000 for contributions to them. Now, I know there's a lot of people that are getting excited. Well, I didn't know about it, my CPA didn't do it or whatnot, but they're not applicable for solo plans. If you've got a solo plan, husband and wife, not something that's going to work for you, okay? They're for non-HCEs. But if you've got a business and you've got 4 employees, non-related employees to you, you might be eligible for, taking $1,000 credit for the setup of the plan. And that's actually in the first couple of years, you get 100%, and then it's a sliding scale, 75, 50, 25, all the way down to 0. But you also get a credit for contributions up to $1,000. So you might find that the economics of the plan works great for you, that you're able to get 90% allocated to you. In addition, you get a $5,000 credit that's dollar for dollar. So again, if you've got a group plan, you set it up this year. This is a great structure. These things were available last year, but they were scaled back, especially on the contribution to the plan employees. Again, something to take a look at, and don't miss out on it if you've got the opportunity there. Real estate. I'm going to go through this at a high level. People talk a lot about real estate as part of their strategies. First of all, there's passive activity rules. Just buying a piece of real estate and renting it out is not going to give you a lot of tax deductions. If it cash flows, it might give you a lot, but you're going to have passive activity rules. You're not going to be able to take those deductions if you're over $150,000 of income. Okay. There's also cost segregations. If you are in a situation where you're able to implement some of these other strategies, maybe being a real estate professional and so forth, you can accelerate the depreciation and take huge depreciation losses, expenses in year 1. Typically, you take a lot in the first year, and then it kind of tails off. It's going to be, a bunch more in the next few years, and then it'll tail off, as opposed to maybe a 27.5-year life. So if you're able to get around the rules, cost segregation is great. I'm going to jump down to the 1031 exchange. Many people are aware of that, but I see people have a lot of real estate. They want to sell There are some structures where you can sell that into trusts and a variety of other things, but realistically, a 1031 exchange is always great. And I've seen people do that where there's a safe harbor. If you think about maybe you're going to want to live someday in maybe you got a rental property, but you'd love to have a vacation home someday, you can do a 1031 exchange into the vacation home, do a 2-year safe harbor, rent it out, and then possibly at some point move into that home and convert it to your primary residence, or use it as a vacation home. So some very cool strategies on the 1031 exchange. Make sure that you consider that. Last two, Airbnb strategies. We talked about passive activity rules. One of the ways around that, and here's what some people do. Again, I'm not necessarily a huge advocate because you get a big bang for the buck, but you want to be, you have to want to be a landlord for this. You can actually do an Airbnb where you're renting the property for very short periods of time, a day, a weekend, a week. If you meet those rules, you're kind of like a hotel, and you're able to then take all the depreciation deductions and to take all the losses in year one. So in theory, you could buy a home, set it up as an Airbnb, do a cost segregation, and have it show up as active. Again, a few other rules you want to consider, and then take some very large losses. Again, it's going to be very large in year one. I've got an article back on that. Also, with the real estate professional, that comes up. But a real estate professional, you have to work at least 750 hours in the trades, which is, I think, 15 hours a week. And you have to do more than half of your personal service hours need to be in the real estate trades. And so if you're a physician or something like that, you're almost never going to be a real estate professional unless you worked 1,000 hours, 20 hours a week as a physician and 21 hours a week as a real estate professional. You might need it. However, it works very well for a spouse. If you're a physician, I've seen this strategy. You're a physician, you make $800,000 a year. You've got a spouse that has a real estate license, works in real estate, manages 3 or 4 rental properties. They generate $50,000 a year in losses. Spouse qualifies as real estate professional. You can use the $50,000 loss to offset other income. Okay, great structure. Take a look at some of the resources and talk to your CPA about it. Investments and insurance. I'm not going to cover a lot on this, but I think I might do a little bit more on some of these strategies. But they on the investment, especially on the insurance side, they get a little complex. But I did want to point out one of the advantages of the C Corps that people are not aware of is that if you have a C Corp and you receive a dividend in your C Corp, those dividends get a 50% exclusion from the IRS. So you're not going to pay tax on those. You're only going to pay tax on the residual. So I've seen people that have built up income in their C Corps. You have to be careful with the accumulated earnings tax, but they've built up income in their C Corps and they use that to invest basically solely in dividend stocks. And so then they can take the dividend exclusion with a game plan of having an exit strategy in 5 to 10 years of getting that money out, quite possibly through having ownership with kids and things like that. So again, something to consider. Just so you're aware, you can put insurance in defined benefit plans. Not a big fan of it usually, but it can make sense for people who really need term insurance or really need a certain type of insurance, especially if you're older and you're higher risk, where you can actually put money in insurance. You can actually have insurance within the defined benefit plan that covers you for life, $1 million, $2 million, and you can get a tax deduction for it. So it can work very well for people who are trying to do both things, get the insurance coverage and also have it within a plan. Can make a lot of sense. We may talk a little bit more about that. Investments, municipal bonds. I saw a few municipal bonds a couple weeks ago that were paying interest rates of around 6 to 7%. Obviously, if you're in a 40% tax bracket, that is that's equivalent to like a 10% rate of return. Don't lose sight of any sort of municipal bonds, because at very high income levels, you've got your net investment tax plus your federal and your state. You can avoid some of that on the federal side with the municipal bonds. So definitely consider them in this high environment. Again, I bring up the conservative versus aggressive. I still see people that are putting I had a guy I just talked to yesterday who put Meta stock in his DB plan. Well, Meta went up 100%. Well, that's great, but now his future contributions are going to be suppressed because of that. I also see people that are putting very aggressive investments in DB plans. Don't do it, or at least don't do it without understanding what your goal is and what you're trying to accomplish, and the fact that you can afford it. But make sure your aggressive stuff, the Metas, his Meta stock should have been in a Roth account, okay? Because then it could have been tax-free since it doubled. But again, something to think about. Always take a look at your mix, because your mix of investments will definitely tie into, the different types of investments that you can do, okay? I'm probably going to cover a little bit more on investments. I kind of see this tying into, that 6% Roth rule, some of the megas, some of the other things, making sure that people can build up, a lot of those, deductions and so forth in there. So make sure that you consider that as you're reviewing your investment profile here and doing your tax planning here now that we're getting into the later part of the year. Next slide. This is the most important slide. And for many of you, you're probably thinking, I don't know anything about this and I don't want to talk about it. But I think this is very important for people to listen to this, because people are not aware of what's going on. Your estate, people don't know anything about estate planning usually. So your estate is really the value of everything you own. It includes life insurance that may be tax-free to a beneficiary. It includes your defined benefit plan account. It includes your home, your rental properties. It basically encompasses everything that you own. During tax reform under Trump, the estate tax was doubled, went from 6 million to 12. You can see the exemption now is 12.9 million. And so most of you on this call have an estate below 12.9 million, and that is per person. So a married couple can double that. However, January 1st, 2026, that is going to be cut in half and revert to the old. The reason why it's a $7 million number in the slide is because they expect with inflation, the 12.9 number to go to 14 million, and then they'll cut 14 in half to 7, okay? $7 million, again, add up the value of your house, the equity of your house, all your other, add up, maybe you got $1 million life insurance policy, maybe you've got rental properties, maybe you got a couple $1 million. You can get there pretty quickly. In addition, if you're 50 years old, this, your estate, and you're going to work another 10 years, your estate's going to continue to grow. And so if you pass away today and you've got $10 million, you're fine. If you're a single person, let's just say, you're below the exemption, but you pass away in January 1st, 2026, and you've got 10 million bucks. Your beneficiaries, your children, for example, are going to pay a 40% tax on the federal, something on the state, possibly of $3 million. Okay. And so a big deal to a lot of folks. People don't know it's out there. People don't know that it's a ticking time bomb for a lot of folks, but there are some very cool things you can do to minimize your estate. Estate planning is all about trying to maintain some type of control over your estate and your assets, but getting them out of your estate. The first one I was going to talk about, insurance in an ILET. An ILET it's basically an irrevocable life insurance trust. And people say, well, it's not insurance. If I die, it's tax free. Well, it is. It's tax free to your children or whoever your beneficiary is, but it's included in your estate. So, you don't pay tax on the $1 million, but it can be part of your estate exclusion. So if your estate's below 12 million bucks or 7 million a couple years from now, then no problem. But if it's above that, and so there's some confusion there. People don't understand that. There are some ways to get insurance into an ILET. We may talk more about that. Great opportunity, I think, these days to do other things called a QPERT or a CRUT, Qualified Personal Residence Trusts, and also charitable remainder trusts. Charitable remainder trusts are very good to donate appreciated assets that you can actually take a residual from and not pay tax. Great for people who have big gains in Bitcoin and other things. But QPERTs, you can actually take the home that you live in and say a vacation home, donate it into a trust. You get to use the trust for your lifetime for a certain period of time, and you get that piece, that home out of your estate. And then assuming you pass away after the end of the term, it gets inherited over to the beneficiaries outside of your estate. A great strategy. And if things go wrong with it, where you die, there's a lot of restrictions. If you die, if you sell the home, you can roll the proceeds over. There's a lot of things you can do. But if you get into problems with it, there's really not, it just undoes itself. And so there's not a lot of downsides for a QPERT, QPERT. So we might talk more about that. But again, something that's a QPERT is great right now with the high rates of the high interest rate environment that we're in. High interest rates, when you go to discount, it comes up with low valuations. Low valuations means a low amount that you can take out of the estate. Also, one other point I wanted to mention on that 12.9 million, the IRS has said that if you gift and you do certain other strategies up to that 12.9 million, even when it reverts to 7, they're not going to claw back that difference. So you really kind of get this, I hate to say get out of jail free card from the estate standpoint in the next couple of years, but something very important. We may do a little bit more on this in the future. But again, something that if you bring this up to your CPA is going to know a little bit about estates, but probably won't have much of a clue. So again, something for you to kind of do some due diligence on and take a look at some of the structures and other things that I got. Man, I'm almost at the 1 hour mark. That's essentially it. We'll go into some Q&A. Here's some of the resources I've got. I don't have something for everything, but again, just wanted to make some notes on some of these different strategies. I tried to pull some together. Couple pages of them. Again, they're in the slides, so please take a look at them. And now we're going to hit the Q&A section. I was going to say here that I know some people do have to get off the call, and I'm seeing a lot of questions come in. If there's something that I did not cover, please make a note in the chat. Say, hey, I'd love to hear about this. If there's something that you'd love to hear more about, like, hey, this strategy really interests me, I'm glad to maybe cover it on future webinars. We're going to do a couple more over the next 2 months. Not saying you have to listen to those, but if there's something that someone really wants to see or hear or understand, I am glad to add some of those additionally into this, if it can make sense. And again, we might at some point do some breakouts where we do some other strategies and structures in a little bit more detail. But again, I hope this was a good opportunity for a lot of folks who could, maybe they don't understand a lot of detail about these, but hopefully there's a couple strategies that at least could make sense for you. And good luck on it. Again, hopefully your CPA can help you on some of these items. So let's take up to an hour. I'm going to have a sip of water here, and then I'll start to go over some of these strategies. Realize that a lot of the answers to a lot of questions, unfortunately, in taxes are, it depends, right? Because your situation's unique. So I don't know if I can talk a lot of specifics about people's situations, but, certainly if, I can give you like kind of my 2 cents on how this structure might work or how to structure it or how to set it up, then we will try to do this. Okay. Phil, company's not going to make any money in 23, a lot of money in 24, cash reserves. Would you make a cash balance plan contribution for 23 to create a large carry forward loss to shelter 2024 property? Can I pay myself zero qualify and still qualify for a 2023 contribution? Wow. Well, you may be able to, if you've got a brand new, cash balance plan, probably not. If you've got an existing one, you might be able to fund up to the maximums and still take that. When it comes to a carry loss, if you're an S Corp that is flow through, probably not going to generate a carry loss. If it was in a C Corp, you could carry it over to next year. but tough to say. Can you pay yourself salary at 0 and get it in? No. If you're setting up a plan, I mean, there are some situations where we could do prior service. Might not be the best thing for you. How do salary deferrals affect contribution limits? Salary deferrals, you can put in the maximum salary deferral, but you have to at least have income. So if you pay yourself, $10,000, then you can get $10,000 into a 401k. If you pay yourself 40 grand, then you can only get 30 in up to the exemption. Okay. So hopefully I covered a little bit of that. What would classify as high income? Gosh, tough to say. Rohit, different strategies, I guess. There's a lot of these, there's some of these structures that'll work very well for someone making, 3, 4, 500,000 a year. But there's some that I think when you hit 7 figures of profit, then you've got a multitude of structures available to you. And so they're going to really help you do a lot of, combined structuring and things like that on some of those. So again, it just depends. If you want to be more specific on, hey, my income is this, do you think this strategy would work? I'll give it my best guess. Higher interest rates, lower funding range. Is this valid for CB plans or traditional DB plans? Both. Now, they may not affect your target contribution, but when the actuary does a funding range, they have to use the range on the high end is used at the federal applicable rate. So your target is going to stay the same, but your funding range, and I'm just going to make up numbers. Maybe your range was 100 grand minimum last year, 125 target, 200 high end. Now this year, you'd have the same range, but instead of 200 at the high end, maybe it's 175. Be careful. We really want people to fund at the target. We're planning on doing another webinar to talk a little bit more about the specifics of the plans and how they can funnel through, but definitely be careful about that. Okay. Is there such thing as a retraining tuition plan credit, set aside money for retraining close the company? Look, there is a variety of types of credits that have been generated recently and some things under the IRA, the Inflation Reduction Act. There is certain types of retraining, hiring certain demographics of people over and above the discussion, because there's some very specifics. So I am aware of a couple, Jim, but I don't get too far involved in the details, but definitely look into some more detail. I don't know if you can set it aside for retraining once you close the company. But again, something for you to look at. Sorry if I don't have a lot. Augusta rule. Can you do with any owned property? What if I office in the home? Can I still rent out my hubby's business? As a general rule, yes, it is. This rule came into place. Well, I don't know. I think there were some senators many years ago that had properties, but I think it was originally called the Augusta rule, I think, because obviously people traveled to Augusta, Georgia, and you had wealthy people that said, hey, I'm going to rent my house out for 2 weeks during the Augusta, not a big golf guy, but during the Augusta golf tournament, and get free income for that. So as a general rule, I think you can do a lot of that. I see people do it to C Corps and S Corps. Take a closer look. There's a lot of information, Cheryl, out there in the Augusta rule. It's not going to be a home run, but maybe you can get $5 grand in or something like that. What is an example of oil and gas investments? There are a variety of partnerships and funds where you put kind of like conservation easements. You put $20,000, $50,000 in to a big $5 million fund. They go out and they invest in oil and gas and a variety of things. And what happens is they generate a lot of losses on the oil rigs. And there was a special criteria set up in the law where the oil, those losses, I know we talked about them being passive and you're not able to take them, but these ones are going to allow you to avoid the passive loss rules and allow you to take all those losses. It can work out very well. But I'm not a big fan of just the sake of taking a tax deduction. Make sure these things are economically viable structures. So it's kind of like the solar and investment tax credits. Be very careful with some of those to make sure there's some economic intent. Again, we might do a little bit more of a deep dive in that at some point down the road. Working interest on a rig, there you go. So yeah, it's got to have the capital equipment in the rig because that's where the depreciation. Recommend a company to help set up a captive. From my experience, the break even is about a $75,000 deduction before I start to get a tax benefit if I'm in South Dakota. One of the ones, there's a couple that I've used. There's one called, I just go to the website. I think it's, I'll type it in here. I think it's 831B admin. They've always done a decent job. .com. There you go. So I think either way you'll find it out there. They've always done a pretty good job. I've had some people that have used that. The break evens are tough because you're going to have a plan for a few years and you got to have a plan on getting the money out. So again, a structure that can work very well, probably more on the high end though. If you've got earnings of $1 million a year, that can be a very good structure for you. Captive's not going to work for someone making $300,000, $400,000, $500,000. You're not going to be able to put a lot into the plan and the fees will eat you up. So only makes sense on this. Let's see. Tom, as an EP lawyer, I don't personally need more information on Curage, but I encourage you to teach more about it with others. It is a good strategy for many. Thank you, Tom. It is. Not a lot of people are aware of it. And there's not a lot of downsides. If the QPERT blows up, for lack of a better word, because you die early or you don't want the property anymore or whatever it is, the property just rolls back into your estate and you're out the fees to set it up. So again, some cool structures. I'd love to talk a little bit more about it at some point. And maybe you and I can talk about that at some point. Tom, if you want to do something, send me an email on that, Tom, and maybe we can do something. Okay. To be a real estate professional, you need a license or just work 20 hours a week. You need to work two criteria. You need to work at least 750 hours a year, which is 15 hours a week. And you also need to work more than half of your personal service hours need to be in real estate. So for example, if you work 750 hours, but you work 1,500 hours as a physician, you don't qualify. You hit the 750 rule, but you don't hit the 1,500. You don't do more than 50% of your personal service hours. So great for a spouse, great for maybe someone working part-time, but it's just not going to work for a lot of folks. I don't know. You can get around the licensing. So a licensing in and of itself doesn't necessarily mean anything because you can be managing a variety of other types of things. But obviously it helps to have a license and work those hours to show, especially if you're a spouse looking to take big tax deductions, your husband. David, I would like to see a webinar geared to how a personal would structure their various corps to maximize benefits. We see a lot of people operate a lot of corps and holding companies to maximize deductions. Well, that first slide up on entity structuring, that one is a great structure. That is my favorite structure. The biggest issue is maybe we can talk a little bit more about that in future webinars, David. But again, I'm not charging anything for these. We may come up with some sort of calls where we get into more details, where we start charging for these, that type of stuff. But I also want to feel that I want to give my clients just a little bit of insight because, again, people bring these up from time to time. And now I've got a video that I can say, hey, take a look at the video and you'll find some cool things. By the way, I'm going to have my own channel set up here, the CPA channel, and I will put this out there on the channel as well. So if you forget about it and you're bored and you can't sleep a year down the road, you can pull it up. Best way to get extra income out of a C Corp. Would dividends be best outside of fringe benefits? Love the ability to take fringe benefits out, but you have to dividend it out. But you've got 0% dividend rates at the lowest 10 and 15% tax at very low tax rates. So if you can have kids take the money out, Maybe you're going to give your kids some money for to buy a home at some point. Put the money in, have them dividend that out to you, or dividend that out to the kids, so you get a deduction. You can also keep the investments in the plan and do the dividend exclusion. But you're right. At some point, you're going to need to get the money out. You can do loans. You got to be very careful. A lot of times, what I try to do is plan for an exit strategy. You make $1 million a year, and then you plan for a year where you make no money, and then you can dividend out of C corps. You can convert, pre-tax to Roth. A lot of cool things that you can do in a year. I know it's not easy to plan for that, but again, something for you to kind of think about. What benefits can I get if I work as a real estate professional? Basically, you're able to take all the losses from your real estate and use that to offset your other income. Okay. Augusta rule will be used on multiple properties or just one? Good question. I don't know the answer to that, David. You might want to check the guidance. I wouldn't personally, I wouldn't get too aggressive on it. Yeah, it's great. You can throw an extra $5,000 or so in, but certainly take a look at it. Maybe reach out to your CPA on that one. I apologize if I don't know it. We are able to help high income net worth specialize in designing, restructuring tax advantage with flexible opportunity way. Is there a way we can partner to help each other put together a course if you want to go through? Lakshmi, you're welcome to send me an email on that. That's fine. I can talk to you about something like that. Serge, how are you doing, Serge? S Corp reimburse for employees, accountable plan for renting out part of the family home. S Corp is allowed to have accountable plan, can rent out the family home for its operations. Technically, you're going to have income though on the rental side, so that's going to be tough. That's why you might want to consider doing something like the Augusta rule. So you can do that. It kind of works like a home office deduction surge, and so you've got to be very, very careful. S Corp formally rents the house. Pay rent to that person on the Schedule E. Yeah, half sounds like a lot, but yeah, again, some considerations if you take depreciation and things like that. I don't know if I completely answered your question there, but it is tougher, Serge, with an S Corp. I will tell you again, S Corps, great structures. Everybody's familiar with it. They're great for bread and butter businesses, but they're not going to give you all the fringe benefits and the big bang for the buck that you might look for with some other things. Okay. How does DB impact QBI deduction? Wow. It will reduce your taxable income, but there's adjustments that you've got to make for your W-2. But the QBID deduction can help you stay below the thresholds. I think we hit that a little bit more in our webinars, but that's a great one for you to go over with your CPA. Your CPA should be up to speed on those types of questions. Is there a way to get more information on a regular basis? Sometimes attending webinars becomes tricky. Well, the biggest problem I have, guys, is I got a business to run and I got to earn a living myself. So, I can't do a webinar every day and earn a living. So who knows? But attending the webinars, remember, a lot of people, I do encourage that if you can't make the webinar, sign up because you'll get a replay so you can listen to it on a regular basis. There you go. Serge posted an article there, some information on real estate professional status. On kids for dividend, do they own stock in the corporation? Absolutely. They'd be an owner in the corporation, and then you would give them a dividend out pro rata. If you can keep a child's income rather low, you can take a very substantial dividend amount can be taken out of the business and pay very little income tax. So again, this can work great. If you've got kids in college and you're like, in a few years, I want to give them money for a wedding. I want to give them money for, a car. I'm going to give them each, 20 grand for a down payment on a house. You might be able to structure a C Corp to where they can take those dividends. You get the tax deduction. And then when the dividends come out, they're going to pay some tax, but it might be very negligible. That structure can work very, very well. So anyways, take a look at it. Will recording this meeting be available? I think I logged in late. Yes, Abhishek, you're going to get an email link on this tomorrow. It'll also be up in the YouTube channel, on my personal YouTube channel here, probably in the next couple days or so. Eric is taking care of that. For an HSA, is the only requirement high deductible health insurance plan? Any way around that? Yes, you do need to have a high deductible health insurance plan, but there are ranges. And I know, like on my card, I have Blue Cross Blue Shield. It says the ranges right on the card, and the ranges have gotten very liberal. Realize that the IRS wants you to qualify. So I encourage you absolutely to be able to do that. And if you can do the C Corp with the HSA and work around the deduction limits, it can be a complete home run for you. So a lot of really cool things you can do on the medical side. Again, I keep highlighting why the C Corp is such a cool structure, but even though it's tricky, and you gotta make sure you understand that. Will the chat be included? Yes, everything here is all being recorded, so you should be fine. I set up my C Corp to be a management company, my S Corp from my insurance business. Is there a good rule of thumb? Watch how much I should put into the C Corp or not. You know, this gets back to economic substance. I mean, typically you want the bulk of your income to go to your S Corp because it'll be subject to flow through taxation, and you want a smaller amount to go to your C Corp because, again, you can take advantage of your fringe benefits there and all the other structures. That being the case, you can take some of the deductions for your cash balance plan and all those other things on the S Corp, take some of the other fringe benefit plans on the side. So again, very small amount. The way I've seen it structured is partnership agreement. Well, you have an S Corp. S Corp maybe enters into agreement for, maybe it's going to provide IT services or other types of stuff with your company, and maybe that's $2,000 a month or $3,000 a month, and that gets a certain amount in. Again, depending on what you're looking to accomplish, you can get a little bit more set up there. So not really a rule of thumb, but you do have to understand economic substance, what's reasonable. If you're just doing IT services for a small company, that probably doesn't justify a $100,000 salary. You know, if it's 5 employees, right? That might be $10,000 or something. So it's gotta be reasonable. It's gotta pass the sniff test. Robin, you're very welcome. I've got an Empyrean YouTube channel, Cheryl, that I recommend that you probably dial into, but I've also got a channel for myself. I've just got a few videos out there. I'll probably put it out there. So take a look, Google my name on YouTube, and I think you'll be able to find it. If your real estate is cash flow positive, how do I show losses, phantom expenses? Well, the best way to show losses, I'm not sure what a phantom expense means, but couple of things you could do on the real estate side. You could do a cost segregation or something, Jasdeep. You could buy a new property, do a cost segregation, take huge depreciation deductions in that year. So that one property shows a bunch of losses and your other 5 properties have income. The losses on the one can be aggregated with the other one, so you show one big loss. You also could potentially, let's say you're making $100,000 a year on, let's say you're making $100,000 a year on your rentals. You could set up a management company, take that $100,000, take the expense on the personal side, send that over to a C Corp and set up some fringe benefits there. Can definitely make some sense, Jasdeep. Talk to your CPA about that, and hopefully that'll help out. Andy, life insurance in them. Life insurance can absolutely. You can take life insurance and you can put it into a plan, and you basically are getting a tax deductible for contributions made to the plan. It also, because of the way life insurance is structured, it allows you to get very aggressive insurance contributions in. So if you really want the large contributions and you're interested in, understanding, you need the insurance and you want the tax deductions, it can make a lot of sense and you can pull it out. Overall, long run, it can, done those strategies. They work great for the right person. They work great. There you go, Cheryl. A lot of new acronyms. Lakshmi, tell me more about this management company. Well, basically, you'd set up a C Corp. It would be called Jasdeep's Management Company. You got 100,000 in profit. You send that $100,000 of profit. You take that on your Schedule E of your rental property. You take it over, and it becomes income to your C corp. And that C corp is set up to manage your companies. Your company, now you have to pay yourself a wage through that C corp, and you can set up other types of retirement structures, or should I say fringe benefit or whatnot through that. So that can work very well. Again, something I would think if you've got a decent enough CPA, they should be able to help you out on that. Rest of the people I think are asleep by now. Did I miss any? How much is the educational credit a year? Gosh, I'm trying to think if it was indexed for even next year, but it's going to be, you know, roughly $2,500 a year per kid. So anyways, take a note at what it is and see if it makes sense for you to do that. In fact, you could have your child help you on your management company. How about one property as a loss? Jasdeep, one property as a loss and the other ones make money. If they're all part of a passive activity, you can use the loss on one to offset it. What was the first thing I said about the management company? I don't know, but that it would be a C corp and you would pay yourself a wage through the C corp. Anyways, any good comments? If you want to give me some other comments, maybe people can give me, did you, here's one on, from Edith on estate planning. Maybe I would be curious to hear if anybody has anything to say about the estate planning. If it was interesting, if you learned some things, very important. Edith, if me and my husband's total assets is below 14 million, to change the estate limit in 2026 won't affect us. That is correct. If it's well below, but remember, your estate will hopefully continue to grow as you work and make more money, and the value of your stuff is going to go up. What estates do is not only does it get money out of your estate, but there's something called an estate freeze, which I remember I was talking about a Cupid. If I have a house worth $1 million and I put this in there, not only do I get the $1 million house out of my estate, but that house is going to continue to grow in value. And if I got a 14 million estate limit, now again, that's indexed every year, but that house next year, 5 years down the road, maybe worth 1.5 million or whatnot. So the key thing is the estate freeze. It allows these assets to grow outside of the estate, and I think it can be a big benefit, to a lot of people. So even though you're correct, you might be fine. Just be careful. If you're below 14 million, depending on how your assets are titled, and you pass away, and you might think you're fine, but then you pass away. I've seen a lot of situations where people have done little to no estate planning and had big problems. Again, I see this as a problem. We all know what's happened to real estate. We know the market is overall done good. A lot of people are doing good. High income people, wealthy people have done very well over the last 5 years. Poor people, not so well. And a lot of wealthy people, you'll find, add up the value of all your stuff and the value of your business too. It's really everything. And you'll get an idea of how close you are. Javid, C Corp setting up relationship limit between W-2 and dividends. You've got to pay your child a reasonable wage for corporations, Javad. You got to pay your child a reasonable wage for the work that they do, whatever that is. And then the dividend is just merely a payout of an investment interest. Okay, so pay the child the reasonable wage for what they do. Anything that's left over can be a dividend. The rules are going to be very similar to rules for an S corp. It's just the tax treatment is a little different. In a year you have low income apart from wealth conversion, what else can you prepare for? I've established a DB plan last year. Can I invest in DB plan and show a loss on S corp? Well, I would say if you could find a year where you have no earned income or very low, Roth conversion's great, C corp dividend great, selling assets, selling your business in a year where you've got no income can really help. Those are probably the big three that come to mind. Can you invest in a DB plan and show a loss on an S Corp? Absolutely. A defined benefit plan cannot create a loss on a sole proprietor, but on an S Corp, it is fine. A lot of CPAs don't like it. So talk to your CPA, but legally it's fine. There are these things called basis limitations to make sure you can do it. Cheryl, should we have a personal residence trust anyways to keep out of our estate and overall liability? Is it a good overall idea? Well, it helps from a liability standpoint. It helps from an estate standpoint, but you don't get something for nothing with these plans. So if your estate is close to $7 million or close to the limits, that is something you want to consider. One of the things on the estate side for you to understand is that when it reverts to 7 million, it's going to be 7 million per person. So in theory, if you've got a husband and wife, it could be 14 million. However, there's some competing property issues and a variety of things that tie into that. But when the first spouse passes away, there is an exemption to take their amount gets rolled over and does not have taxation, generally speaking. But now you've got, even though that one spouse did not pay tax, and now on the 7 million that the other spouse owned, now the one spouse has 14 million. Well, remember, what's the estate limit exemption going to be? 7 million. So now you got an issue. So how are you going to get that additional 7 million out? And that goes back to Judy's question a while back as well. That's why the two structures I think that are the easiest and cleanest for people to do would be the QPERT and the ILET for the insurance. Okay. Is it true that all S Corp owners must be active employees? No, you can own an S Corp and not be on payroll. Employees are only people that work in the business and they need to have a W-2. But you can have an investor in the business. Usually S Corps aren't great for that. But you could have it. There could be estate planning or other issues. So if you have an owner, they don't necessarily have to take a W-2. Of course, they're not going to get any benefits or anything like this. So eventually transition to a C Corp because of the following year, the QBID. Yeah, another good point is that the QBID does sunset. There's a lot of things that in the tax law that, again, are going to sunset at some point. Another thing I wanted to point out, I had this with a client who below 400,000, you can still take tax credits for kids. So let's say you've got 2 kids, say you got 3 kids. You take $2,000 tax credit for each, that's $6,000. Well, if your income's above 400,000, you can't get that. Well, what happens if your income's 450 and now you've shifted 50 grand into a C Corp? Now, guess what? You're below 400 and it frees up credits. So not only do you have income taxed at a lower basis, now you just freed up all these credits that you could take, for your kids. So a lot of cool things on the C Corp side. I don't want to beat it up too much. Can I use a S Corp to pay for disability insurance and life insurance? And will the payout be taxed if that's the case, if I didn't pay up front, took a deduction? No, Abhishek, you cannot do that. For life insurance is not deductible from the S Corp. You can deduct de minimis life insurance, $50,000 on a C Corp. The only way to make it tax deductible would be to run it through your DB plan itself. So put the insurance in the plan. All right. Not a lot of questions on estate taxes. I think it was probably over most people's heads. That's okay. Perfectly fine. At least it's out there, and at least you know more about estate taxes than you did before this call. Gotta run. You're very welcome, Serge. Any other questions? Anything that I missed? Any other comments? Anybody awake still? All right, make sure you've got the handouts. One more question from Minesh. Looks like we'll do a couple more and then we'll be done. Everybody else is welcome to go. Again, I hope you enjoyed it. Please, if you're leaving, if you enjoyed it, if there's something you missed, if you want more in the future, that type of stuff, you can certainly give me some comments here and some ways that we can customize this. Using a DB plan to buy life insurance. Well, there's some rules, but let's just say you're going to put, let's just say you're going to have $100,000 contribution to your DB plan. There's certain rules, but you can't fund more than usually 50% or sometimes 25% into a DB plan. The plans themselves are a lot more complicated and you can do them, but what happens is you make the premiums out of the plan assets. You make the contribution. So you get life insurance that's tax deductible. When someone passes away, they get to, usually what happens is you close a plan in 5 years and you buy the life insurance out. So there's some complexities, but it can be very helpful for someone who's older, wants the life insurance, wants to take the tax deduction, also, likes the fact that there's tax-free income, doesn't have a huge estate, and is willing to buy this out of the plan at some point down the road. Maybe we'll expand on that at some point, but it's a rather complex issue, but it can make some sense. Maybe we'll do a webinar on that at some point. If you inherit money in India as a U.S. citizen, if you inherit money from India, generally speaking, most states don't have an inheritance tax. So most of what you inherit is tax-free. There can be some issues. There can be some stuff that's gone on between different states. So probably a tough question. But as a general rule, when you inherit money, that's generally tax-free to you. There's only a couple states that have an inheritance tax. It is only taxable to the estate. So most of the time when you receive an inheritance, you're good to go. Yeah, I'm gonna punt, Karishma, the question on the India. But what's gonna happen is, assuming you're not taxed on the 10 million that comes in, that 10 million then becomes part of what you owe, and now you've got to jump through all the hoops and get the and now you're going to have an estate planning issue here. So assuming it's not taxable when you receive the money, talk to an estate attorney on that. If you receive it now, you've immediately still got an estate issue here because you pass away here. You could have a problem. So again, something to think about. How much would someone have to pay to buy the life insurance out of the DB plan? Wow. Very, very tough question. Usually not a huge amount. It's typically around the fair value, the cash value of the policy. Probably not a huge amount, Jasdeep. Maybe I'll cover that. Why don't I try to cover a section of that maybe at some point down the road? As a matter of policy, we are not currently doing insurance in DB plans, mostly because they're not a great fit for a lot of people, and it seems that a lot of people have they're very complex. We charge an extra $1,000 to administer them because there's a lot of headaches. But maybe we'll have an extra slide on the next webinar to talk a little bit about that. Okay. Again, on the life insurance, there's an article I did put in resources. I encourage you guys to take a look at the resources that I've got that covered a lot of these things. Look like we're all set. I guess we're going to wind this thing down. Hopefully everybody learned something. Thank you very much for attending. You'll receive a replay, and you'll also see it out there. And again, hope you all enjoyed. Have a great rest of the day. Bye-bye.